Today's video is on some common tax traps for single member LLCs for anyone who may not have done full research and tax implications before creating a single member LLC. So the most important thing is not to, here it says commingle, but to in any way combine or share personal and business finances. That would include taking money from the business and putting it in your personal checking account without following the IRS's LLC draw procedures. That's illegal. You don't want to do that for sure. Um, if you were to, for example, use your house as collateral for your business, you really don't want to do that as well, because then your business becomes mixed with your personal, and any business liability that you were protected from by having an LLC now becomes personal liability as well. For example, they can now take your house for business liabilities. Like if you took loans, they can take your repossess your house, repossess your car, and if things get bad enough, if you borrowed too much money, then they can even garnish your paychecks in future jobs, which means the IRS can take money straight from your paycheck before you even get paid, which is a really tough situation. So let's not do that. Anything personal, anything business, keep them 100% separate. And if you're going to put money into the business or take money out of the business, then follow the IRS guidelines. Neglecting quarterly estimated tax payments. This one's a big deal because the IRS at the end of the year is going to say, did you pay enough in taxes, or did you not pay enough? Well, if you didn't pay enough, they're going to charge you interest. And if you were substantially under what you should have paid, they're going to charge you a lot of penalties as well. And that can cost you a lot of money. So every quarter, you should be filing your uh, estimated taxes that you would owe in that corner to the IRS. Inadequate record keeping, that's irregardless of the business. If you don't keep your records properly and you accidentally underreport or overreport your income, and you take that as a net gain or a net loss on your personal finances when you're taking a draw, again, that's tax fraud, and you absolutely don't want to do this. Misclassifying of workers and mishandling payroll taxes. This happened to me at work one time, where contractors were being treated as employees, and you want to make sure that that's not the case. So contractors are getting 1099 forms, and they're clearly signing contracts for one project at a time, whereas your employees would be would sometimes we say on the bench in between jobs. And so you want to make sure that they're clearly spelled out between an employee W-2 and a contractor 1099. And then your tax status and elections. You just need to make sure that you fill this out properly. And when you're taking uh, your money out at the end of the year, or if you're taking it out weekly, or whatever the case may be, you want to take it out as an LLC and not as an S corp. An S corp being, you would write yourself, or you would create yourself a W-2, and an LLC would be, you are taking a draw as a member. So those are two different ways to handle it. You can actually do, by the IRS, an LLC that's treated as an S corp. If you don't really understand the IRS requirements for this, you'll have to look them up. But the easiest way that I did this was to just take a draw as an LLC owner. So I hope this helps. There's a lot to think about here. And if you have any questions at all, make sure you consult the IRS website directly. Don't listen to anyone, um, especially anyone who is not qualified, which includes me. I have no certifications here. I'm not a financial advisor. I just happened to run a company some years ago and happened to do extremely well in investing and as a software engineer, running large projects as well. So this is my opinion and not something you should necessarily listen to. Do the research for yourself. And um, I hope your journey goes well in sobriety in Jesus Christ. Thank you for listening.